So I actually want to start macro and talk about the difficulty we've seen in emerging markets, the potential trade war and all of that. How do you view that in terms of global oil demand going forward?
So I think the important thing to keep into account here is that, broadly speaking, the macro environment has been ticking to a more concerned state over the last 6 months. I think the oil demand dynamic benefited from very strong diesel demand and synchronous global growth. All industrialized countries firing on all cylinders, and that key EM demand growth is a key part, 20 to 30% of the global oil demand mix, and was, being in a robust state for, at least a year and a half. And I think there are a lot of concerns now when you look at the currency effect, in addition to the oil demand effect of higher prices. So both the price and the income effect is starting to raise questions about the sustainability of the 1.5, 1.8, 2 million barrels a day of demand growth kind of profile that we've seen over the last couple quarters. Remember Q1 in 2018, we saw almost 2 million barrels a day of demand growth, and we've expected that demand growth profile to start to tick lower over the course of this year. So the trade tensions give a lot of concern to the oil demand growth profile because it's affecting that EM component of demand.
The other part of it is we've seen a lot of countries take off the subsidies that they had, which makes them even more sensitive to fluctuations in the oil price. Are you having to factor that in yet to your oil demand thesis?
Yeah, definitely. I mean, when you look back at the way at the end price to a retail consumer in some of these countries, we're back at levels that we were seeing back in 2007 and 2008. That's an incredible full circle that we've come, and that's as a result of tax changes and subsidy removal in some of these key countries. You're seeing that in both the Middle East and in key Asian consuming countries. I think the other key elasticity, or the other key flexibility that we're seeing on the demand side right now, is in addition in China. So the refineries in Shandong kind of backed off of their purchasing over the course of the last 2 or 3 months while they were waiting for government approval. They've now received that approval, and that purchasing is now picking up again, and it's helping to tighten or further flatten the oil curve. So that extra physical demand for crude by those refineries is also having an effect in more of the short term.
So some say that it's a good thing we have a trade war and emerging markets are falling off, because or else we see a huge spike in oil.
Right.
Would A, do you agree, and B, you just upgraded your oil price forecast for 2020 and 2025. Walk me through it.
Sure. So I think on the first issue, when you look into the future, the question of the trade war and the broader economic backdrop here, it becomes a question for U.S. energy policy. It's only as a result of this trade war that the administration has actually gotten kind of lucky, because otherwise the sanctions effect of cutting off supply to Iran or from Iran, and the effect that we're seeing for the geopolitical impact in Venezuela is also resulting in lower supply, and it's coming at the same time as these demand questions. So I think that if we didn't have these trade tensions, we would obviously see prices even higher than where we are right now. So that brings me to your second question, which is what changed sort of in the last year. We do this report on an annual basis. This is the fourth time that we've tried to give our view of where we see prices over a 3 to 5 year time frame.
And to be clear, 2020 you now see $75 oil, and then
right.
2025 you see $80, which is now $15 above where the curve is.
Right. And so I think it's important to look at what's happened in the last year. We've got Venezuela that's clearly ticking lower. Already production is about 1.4 million barrels a day, 800,000 barrels a day lower than it was. We've got Iranian sanctions on Iran that are likely to take off up to about 1 million barrels a day off the market. And I think the other thing that we're discussing here at this Barclays Energy and CEO conference is the question of what the U.S. producer is going to do. We just finished a meeting, a presentation from one of the U.S. C&Ps saying, look, we are not going to chase a higher oil price. So I think that another big sea change that people need to recognize is that the U.S. is not such a swing supplier as it once was conceived to be a year ago. So these producers are seeking returns, and many of my colleagues on the equities research side are highlighting this. So an increase in cash flow is not necessarily going to translate into incremental drilling and incremental capex.
The other part of the story, specifically in particular with the Permian too, is that the core acreage, the Tier 1 acreage, has already been used or drilled, and then now you're going to go out to like the Tier 2. Is that a real narrative that's yet reflected in the market, or what?
I think that there are certain companies that are saying that. I wouldn't say necessarily that all companies are saying that. Certain companies are saying, well, look, we've delineated in this new area, and therefore we're calling it now Tier 1. We've de-risked it. We've had great results in this area, for example, in the Bakken, and therefore it's now classified as Tier 1 for that particular company. So I think that it's clear that over the course of the next 2 years, there's going to be constraints to the growth story. Whether it's takeaway constraints, labor constraints, completion crews, that's going to be an issue for the next 2 years. But I think when we look in a longer term basis out from 2 years to 5 years, it becomes an issue of what is the quality of the remaining locations. And there it's going to become an issue, and that's generally why we expect prices to continue to rise through the medium term, despite the questions about EVs, despite questions about demand growth over that period of time.
Standard Chartered had a note out that caught some headlines. It was titled Red Queen, because basically saying that productivity is not matching decline rates. Is that true from your point of view?
Yeah, I think that I don't know if that's necessarily a new concept. The guys at Bernstein, I've also, titled a report I remember from 5 or 6 years ago called the Red Queen effect. And so, generally this is, people running on a treadmill, and you have to do as much just to stay at pace. I think that is the case in certain areas. I remember a year ago, there were certain CEOs here that were talking about, there's only 3 main plays and everything else is not worth looking at. And then you come to the conference here and you hear producers talking about the Powder River Basin, they're talking about the 3 forks under the Bakken, talking about the scoop and stack and the improvements that they've made there. And so none of those places are necessarily going to be on the same scale as the Permian. But at the end of the day, when we look at our oil market balances for the next 2 to 3 years, we're just not convinced that the bull story is there. Of course, if disruptions worsen more than what we expect, then there is a case for $80 or $90 oil. But it's our view that given these issues on the demand side and concerns about a recession, that we don't think that it would sustain that level for very long.